Hello, everyone. Thank you for joining us again today. I've got Anthony Hall with me. Anthony and I have known each other, well, definitely over 10 years. We've worked together before. We can probably say who it is, actually. We're doing something quite complicated for a large utility company. Let's leave it at that rather than identifying anyone. In terms of Anthony, well, I know Anthony is a finance transformation expert, but really what I know Anthony for is his ability to find profit, revenue recognition, unraveling complexity. These are all quite topical at the moment because quite a few businesses in the UK are finding it difficult to hit their numbers. And we're starting to see a knock-on effect from that. And this is about the time when you bring in someone like Anthony to come in and not just look at cost reduction, but look at how to achieve those numbers and find some of that profit. But I'll pass on to you, Anthony. You can introduce yourself and say hello to everyone.
Hi everyone. Anthony Hall, and I usually introduce myself in terms of the clients that I worked with. So I've worked with a lot of big companies, and my favourite phrase is that I've worked with Disney through to the Ministry of Defence. So it's kind of from the fun side through to the really serious side, and Disney was really serious. So I've done a lot of work. I tend to get the jobs that nobody wants to do or they can't do internally, or that they just want to stay away from because it's too difficult. So I usually get that kind of thing, and that's what I enjoy as well. So systems problems, problems with profitability, and also an awful lot of companies that are in trouble. So to work with and try and find a way out of that for them. So I think that's me really. I think I've been described one client that's used me about 3 or 4 times says that when he finds himself in the proverbial, that he always rings me to come and help. And he's an accountant as well, so it's
That's nice to have that recognition. I think the way that we describe you to clients as well is, yes, finance background, you understand finance completely, you understand where the profitability is, and you work for the board. These are people that have got control, decision control over the balance sheet, which is really important, especially given the conversation we're just about to go into. But you're also discreet. And you also make sure that you deliver what the client's asking of you, but you do that in a very nice, discreet way. You don't need the fanfare, which I think is particularly important.
Yeah, that's correct. I think as well, Mark, if I could just quickly, I think it's probably worth mentioning that I ran a training business as well for about 5 years alongside my accounting consultancy. So I've run leadership programs and commercial awareness and financial awareness programs. So I tend to get on very well with the people in the organisation at all levels, and as a result of that, so you can find just as much by talking to one of the invoicing clerks as you can to the board as well sometimes. So I hope that comes across, that I can work at both levels,
Yeah, well, we definitely have got experience of that with a client that you worked for with us, so that was certainly the feedback. But in terms of the subject today, we've sort of pre-agreed a title to help us stay in a kind of swim lane, and it's run your business from the balance sheet and also avoid using Excel to make more profit. And they're 2 separate things, aren't they? But they're kind of joined as well at the same time.
Yeah, exactly. I mean, as everybody sort of knows, the profit figure is just one line on the balance sheet, isn't it? And so I think I always start with the balance sheet whenever I'm asked to go and help in particular companies that are struggling, because that's often where both the cash is and very often the profitability of the organisations is kind of hidden or masked within that. So I've had simple stuff where they're not recognizing revenue properly. They're hiding costs. The accountants are hiding costs. I worked with one business where we actually wrote off nearly 26 million from the balance sheet because it was just hidden away, by accountants who were scared to reveal the true profit of the business. And it's one of those things. So I mean, every single business I think I've been in, we found both cash and profit in that balance sheet. I'll give you a couple of anecdotes just to make this a bit more interesting. We found in one company, I found a small investment into a bull business for. They rented out the bulls for their to cows and they were struggling, and the business actually invested in basically in a customer, and that went unnoticed until I looked at the balance sheet, and we managed to get the £50,000 loan back that the guy who ran the bull business didn't pay back. So just simple stuff like that people just leave and forget, through to an oil and gas business, where where I noticed that they were doing their calculations wrong, because the stock figures were being used to calculate the price of fuel, and by fixing that, and changing the way that they use the pricing model, I managed to get them at least £1 million a year in profit, because they were picking the wrong numbers. I've got hundreds of those examples that I could go through, but it's all by making sure your balance sheet's clean, putting your controls around, making sure you've got good controls around the balance sheet, and then once you've got that in place, the kind of profit sorts itself out.
So that makes sense.
Yeah, and very often companies do it the wrong way around. They spend all the time after month end working out the profit figure and getting the profit figure right in inverted commas, and then they do the balance sheet once the P&L and the accounts have been closed, which is really the wrong way around. But yeah, it tends to be something I was trying to think of how to describe the process to you today, but a lot of it's intuitive, based on experience.
Experience matters, especially when we're at this point in the economic cycle, potentially, whereby things are getting tighter, and I think we're seeing lots of indicators of that. When we talk about indicators, let's say, for instance, if I'm an investor and I've got multiple companies that are under my umbrella, what are the sort of symptoms I should be looking out for that make me think there could be a problem there?
I think I've recently done some work for bondholders in a large business, and it's really about sort of looking at the company as a whole, how the profits interact, especially where you've got multiple subsidiaries and there's possibilities of moving money around between those subsidiaries. And then, I guess once you're inside a business, the analysis of the debtors, the creditors, to see how they deal with those and how they age them. That's very often an indicator that the company is going to have cash issues. So I think one of my clients, which is now bust, I worked for about 2 years before they went into administration, and I looked at the cash flow and basically did some graphs, and I identified the date they would go out of business if they didn't act, to the month. Really? And it was just simply drawing a line on the cash position and looking at the the overall pattern of what was going on and the cash deterioration, and just drawing it. And I remember getting a phone call from one of my friends who was working there at the time, and he said, "You bang on, Anthony. You got the exact date." So
No way.
yeah.
Well,
So but I think to me it's like simple. It's the way sometimes that they review things. Like the traditional way of doing cash is about the movement in your debtors and creditors, isn't it, against your budget. But what I tend to do is look at the actual transactions that occur rather than the forecasts and budgets, and then try and extrapolate those out across the time. So it's stuff like that, really. I mean, I think, and then diving into the profitability aspect, it's looking at the differences. So if you're looking on the cost side, on the vendor side, it's really about saying how quickly do they send invoices from when you receive the goods, and then how quickly do you process them and get them onto your books, and making sure that recognition of costs is at the right time against the sales that you made, And then but yeah, as I say, very hard to explain, but it's about understanding the patterns, and most businesses are the same. They tend to have poor controls over sending the invoices out, and they don't have the adequate backup. And I don't know if you've got any clients in building and construction, but it often is the case there where where the invoice disputes can go on for months. So it's making sure you're ready to go to court the day you send the invoice, and having your process. So it's but yeah, and I tend to see myself more as a traditional financial accountant rather than a management accountant. But understanding the budget margins is something that every company needs to do to make sure that they actually do meet reality. So rather than just looking as a budget as a whole, actually diving into customer SKUs and things like that, and making sure that the margins that they think they're going to achieve are actually the ones that they're going to achieve. So, but yeah, it's.
So if I'm an investor, then what I'm doing is I'm looking at generally across the business and making sure that the metrics and the ratios look about right. Is that the good first indicator?
Yeah, that would certainly give you a first indicator, and then I think it's looking at the. I looked at one company that was for some bondholders where they were basically moving some of their profitability to another company in Jersey. So the bondholders weren't aware of that, and the margins were less, but the overall group of companies was actually okay. But it's just certainly making the investors aware of that, and how things are actually working within the business, because as sometimes business owners don't actually tell the truth.
Well, I think
they like to hide things. So.
Well, we're into behavioral psychology now. And I think what I've seen a lot over the years, because we do a lot with businesses that are in what we would call forced change, not planned change. This is forced change. They've found a problem or profitability drop. They've lost a customer. I mean, it could be one of 100 things. But what we find is that in the sort of lead up to that, there's been some behaviors that are very questionable. And, those could be that they're, frightened to report numbers that are lower. There's lots of things that are linked to that behavioral side, isn't there?
Yeah, I certainly agree with that. And I think it's sort of an ostrich. Is it ostrich that stick the head in the ground a bit?
It is, yeah, it is.
So I've been into a lot of businesses where if they'd have acted 2 or 3 months before, and it's that kind of hope that the problem's going to go away, and I've certainly seen that where it's just slightly too late, because you you start to deteriorate the relationships you've got with your suppliers and vendors, and then hence your customers. So it starts to snowball a bit. I once wrote a sort of blog for LinkedIn, which was about my friend Sotiris, who was Greek Cypriot. He had a fish and chip shop, and his methods went completely against what you get taught at college in accounting, you know. So he would receive his fish on a morning, and he would hand the fishmonger £1,000 in cash as soon as that fish came through the door. Yeah. He wasn't trying to fiddle his tax, by the way. He was, but and he would do the same for the potato guy. He would go down to the he'd actually send his wife to the post office once a week and pay cash into his gas, electricity, and water accounts. And then essentially what he had left at the end of the week lying on the table was his profit, because he'd paid his staff, he'd paid all those things.
Yeah, I get that.
It kind of goes against, like, push the creditor out as far as possible. But what he found was he got the best fish. So because the fishmonger got paid and knew he was always going to get his money, he offered Sotiris the best fish, and the potato guy did the same with the potatoes. That built his reputation with the customer, because the customer was seeing the quality of everything that he was getting, and his sales went up. And then he'd do the same to the next fish and chip shop, and I think he he's still doing it now, but he just buys fish and chip shops that don't work properly, gets the relationships with the vendors and the customers, raises the quality, and then off he goes, you know. And I always use that as an example in business, you know. So I think I worked with one company that was in distress, and just by changing the way that they were financed, we did some vendor finance, and by changing that, we immediately got a 15% discount from one of the vendors, because we were paying on time and they knew they could count on us. So that just transformed that business. And
that's a great way of looking at it, especially at the moment, because some businesses are finding it difficult from a working capital perspective. You know, as things start to tighten, we get this element of creditor stretching. And we know this happens. In fact, you know, shamelessly, we have people who are experts at creditor stretching. You know, it's an actual job that someone can do. You know, and I think sometimes people forget that. But ultimately, you know, if you're a quality business and you want to preserve your quality and your brand, that's a really good way of getting, you know, the best quality, the top priority in terms of customer service. And you don't necessarily pay more. Often you pay less. Because you know you're helping them with their working capital, and they value that at the moment. So there's lots of ways to look at this, isn't there?
Yeah. I mean, you pay on the price with some suppliers is based on the trust they have in you to pay them, isn't it? And you know, that can very often increase your margins. And there are some banking schemes that are available to bigger businesses where. And you know, the supermarkets use it, where the vendor can go and draw the money down as soon as they've delivered and sent the invoice in, and those kind of schemes help. But if you can do that within your business for your core suppliers, you know, you're almost guaranteed to get your prices down. And I remember doing a big project at Kodak in Leeds, which is closed now, so we can probably talk about it. But that was, you know, that was literally going through their inventory for their facility and finding the best prices online, you know, and then challenging the vendors to match them. So you stayed with the vendor, but you managed to get your prices down. It was like a proper procurement project that I was involved in there. So, but yeah, it's definitely one of the key things, and the chip shop principle is pretty much he had it bang on, because I know how much money he made.
So well, it's a good principle to have, especially if you're not in a position where you're struggling for cash. I mean, in terms of how companies do their accounting, the practices that they have, what we're seeing at the moment is quite a few businesses coming to us and saying, we've got some issues. We need some investigative type style accounting practices. We can see from Excel that there's some issues, and immediately I'm thinking, Excel, really? And you've got a bit of a thing about this, haven't you? I mean, it gives you some indicators, doesn't it, Excel?
Oh yeah, I think my overarching view now is if you're using it for anything other than reporting the numbers from your ERP, there's a problem in your finance team, because very often, yeah, it's massive. I mean, I think and then you're constantly looking at the difference between the Excel reporting and the ERP figures, So why do that? When there's tools out there like Power BI now that you can link automatically up to your ERP system, and very often, I mean, it's not a company I was involved in, but I don't know if you remember Bargain Booze, and this has been in the news, and I actually know the CFO that was there, and basically they went bust because the spreadsheet was wrong.
No. Yeah, that was a private equity backed venture, wasn't it?
Yeah, if you look at the story, the cash flow model was corrupt and it didn't work properly, and so I've got a real kind of, I won't call it a hatred because I think there are uses for it, but anybody who runs their business on Excel is prone to things like that. So and that was heavily publicised as well, and I know same with it was the cafe, and I can't remember the cafe. Was it Valerie?
Patisserie.
Patisserie Valerie. Yeah, that was exactly the same. There was an Excel model that was actually fiddled.
I remember that. We got a phone call on that many years ago, and it was we found a huge hole. Is probably the most I want to say.
Yeah, and the pricing model I mentioned earlier that we managed to make the million on. It was like, that was an Excel sheet that was flawed as well. So because it was picking up the wrong numbers. So I think it can be quite dangerous, and I did work with one CFO, and we discussed it at length, and I think it actually was the thing that got me the job in the end, because he agreed with me that it was like he had lots of problems with lots of Excel sheets, daily profitability charts and all this kind of stuff, and he actually moved to a visual reporting system like Power BI, and he put, on my suggestion, he put a quality mark on the ones that he was going to use. So he put a little indicator on to say, this has been tested, I know this is right, and I'm not going to look at anything else, basically, is what he said. So what that then does is it drives the accounting workload back into the ERP and fixing transactions, So very often there'll be an error in a transaction, and the accountant will fix it in the Excel sheet, but forget to go back and fix the ERP. So it's perpetuated, within the system. And so I've got I have actually written another thing on, why we shouldn't use Excel, basically, and take it off people, because it's just the number of times you see it, and the number of real examples, like the two we've mentioned, Patisserie Valerie and Bargain Booze. It was actually Excel that, it was the Excel that drove them in the wrong direction.
I bet that's happening a lot at the moment, and to some companies it might be just a small amount that they have to just adjust, and we have to do that again. Oh, we have to do that again. But these things compound. I've never seen it not compound. And then you've got bigger problems, then you start hiding, then the behaviors start to change, then you've got a problem because the investors starting to ask questions, and all of a sudden this thing's got compounded, and now it starts moving and rolling faster.
That's
and
right.
Then
Yeah.
it's a major problem, and that's
Yeah.
probably what happened at Bargain Booze.
Yeah. And I think that's why I kind of, the balance sheet to me is the key. If you run your balance sheet and you watch the trends in your balance sheet, against sales, against profit, and you look at the movements in those numbers, you can just see where the cash is leaking, or where the profitability is leaking. I've had another client this year, which I can't name because I am under an NDA for that one, but they didn't know how much stock they had.
Yeah.
And it was critical for their business because they financed all their stock.
I was going to say, sometimes that can be like finance linked as well, can't it?
Yeah, so the stock on the ground wasn't the same as the stock in the system, and they were paying their leasing figures for the stock on the stock in the system.
Yeah.
So it can really cost you as well if you don't get it right.
Well, I think you're right in terms of one of the red flags that, let's say, an investor should have, or like you said, a bondholder, or an element of the board should be looking at is, what am I getting through Excel? What are they using in terms of Excel? Do we have a current finance system / ERP system? Most companies say yes to that now because they're not that expensive, or certainly the smaller ones aren't. If they're still using Excel to some extent every month, that should be the red flag. Then you send someone in like you who has an overview across the balance sheet, across the P&L, across the reporting, the Excel documents, and then whether it's pattern recognition, whether it's experience, or just secret sauce, you know exactly where to look, don't you?
Yeah, that's right. Yeah, exactly. And ask the right questions as well, because I don't think I've ever been in a sort of monthly meeting where they say, "Why is my inventory up?" Or like, "Why are my debtors up?" It's always, "Why haven't we made this margin?" And like, and I think as well, probably for the, I mean, I started life. One of my second job was actually control accountant, so in British Gas. So I guess that's maybe where it was ingrained in me. But just looking through the reconciling items and just challenging what they're actually there for. That found the bull company, which I'll never forget that one. And then and lots of and you find lots of stuff like that that's sort of like, oh, we'll do an adjustment there, and then nobody looks at it for a year or 2 years, and sometimes there's real cash there, sometimes there's not, but very often that, I think having somebody in your organisation that's really good at presenting the balance sheet is vital, I think, now, especially for bigger businesses. Because 100 grand can get lost, can't it, or can be deemed as a rounding error, whereas you can actually, I mean, if you don't mind, I did actually work for a company called Schindler in Switzerland.
I know that.
And Schindler, I did this. This is going back quite a few years, so I think, and when I looked at the business, they had so much cash, Mark, that they had a department just moving the money around different banks to keep it safe. Yeah.
Wow.
So they weren't cash strapped at all. And my opening line, which nearly lost me the job, was, I think because you've got so much cash that you're really inefficient.
Yeah.
And the CFO, like, who was, I was going in to do some work on some of the new accounting regulations, but that was my opening line, because I just looked at it and thought, you could do so much better, than you're doing at the moment. Your debtors are high, your creditors are high, prices, and and you could do so much better. But his initial reaction was, "We are the most efficient company in the world," sort of thing. Look at our cash, and like
Yeah.
Swiss is Swiss, but yeah, but after a few minutes, he kind of thought about it, and he thought, well, yeah, actually, you're right. And they started a program to dive into the balance sheet, to see what else they could, because there's no
Yeah.
reason just because they're doing really well that they can't do better. So it was it
Very true.
made them relax and stuff. So yeah, so that's
I don't think we get many instances now where we've got a business that's got so much cash. I think a lot of
no,
businesses are running it quite tight,
yeah,
and I think there's a move at the moment around cost reduction and so forth. And again, I think we're at that part in the cycle now where people are looking at cost quite stringently. But actually, the typical way of doing that might not be the way to start it. The way to start it might be, okay, are we doing some reporting on Excel? Are we doing some accounting on Excel? Okay, well, that's immediately a problem. Let's get it all into one single source of truth, the
yeah,
ERP. And then it's a lot harder to manipulate. Let's use that word.
yeah,
And then, once we start looking at it in terms of one single source of truth, then we start looking at where the patterns are, the ratios and so forth. Then we know where to dig into. And it could be just a process change. It could be, an operating procedure change. It could be anything like that. It doesn't necessarily have to be something that's a real problem in terms of fraud or anything like that. It could be just, that's the way we've always done it, mate. We see
yeah,
that a lot.
absolutely bang on, because it's kind of, and I think there's a behavioural issue with accountants that they feel like they're doing something if they produce a pretty Excel every month. Yeah.
I
Whereas the
understand that.
whereas the real value is if they're, and also within that, very often they're compensating or correcting things that are wrong in the ERP.
Yeah,
So there needs to be a really good understanding from the finance and IT world that, like, if you fix those issues in the ERP system directly, you don't have to do that monthly correction using Excel and present it. You can just pull your management information through into Power BI and know that it's going to be right.
yeah,
But I think there's this kind of it's a physical act, isn't it? Producing an Excel, so it makes people feel like they've done something. Whereas the
yeah,
real value of the accountant is then digging into those numbers and understanding, are we getting ripped off by the vendors? Are we, like the prices coming through what we're expecting?
yeah,
Why haven't we sold all this product to this customer that we budgeted for? Or, so that it gets them into more sort of real business, doesn't it? Rather than just spreadsheet manufacture, which adds no
yeah,
value to anybody really. And also, I mean, it's slightly off topic, but very often challenging the reports that are being produced, because do they actually drive a decision, or do they drive a change in behaviour, or do they drive a change in process? Very
yeah,
often reports get churned out, like you say, it's just, we've always done this one. This goes to Bob and Janice and whoever, yeah, and they look at it, but do they actually use it? So I sometimes when I sit in the finance director or CFO chair, I sometimes just stop sending everything out and wait while somebody says I
it's a
can't
good
I
plan.
can't work now. I can't
There's,
operate without this. You know.
there's a load of CFOs smiling to themselves at the moment that just wish they dared do that. But I think it's a good idea
Yeah, it's
because it makes
good thing
people
about being
realise.
good thing about it being an interim though, you don't care. So as
Yeah,
long as
well,
you get the result for the business, that you get the results for the business, you don't really mind, like upsetting
well,
years
it's
of
not about
tradition.
politics. It's not about
Yeah,
politics. It's not about that's how
yeah,
we've always done it. It's not even about career progression. It's about good legacy, making it better, and being proud of what you've done. And
yeah,
that's why I
exactly.
love
Yeah,
working with interims.
yeah,
I think we've covered off a few things today. I think the most important thing, certainly from my perspective, is that if you're an investor or if you are someone who makes decisions that are for the balance sheet, then if the business is using Excel, and they're using Excel for reporting, there's a problem.
Yeah.
Now's the time to dig into it, find out why we're not using the ERP system, make the corrections, use the ERP system, and then start looking at where we can make some improvements that affect the balance sheet, not just looking at the P&L.
Yeah, exactly. Yeah. Yeah, that's a good summary.
Wise words, sir.
Yeah, and yeah, because I think as well, and this is something for you really, but it's almost like you should offer a balance sheet review as a starting block for companies,
Yeah.
and then I've done it before where I've said like this will be free if you engage us to put it right, but a balance sheet review is often a really good way of telling or showing a company that you understand them without actually spending a long time there.
Yeah, I agree with that. I like it when clients ask for balance sheet reviews. I mean, we don't offer the interim managers to do them for free, because I'm always of the mindset that businesses value something that they pay for.
Yeah.
And also, if it's for free, is there a hidden agenda for them to find some issues that then they have to then fix? Classic consultant type model.
Right. Okay. Yeah.
So yeah, I quite like when they pay for it and they pay a fair price for it. But how long does a balance sheet review take?
It depends on the company, but you sort of 3 to 5 days depending on the company, and you can often give. I mean, I've got a friend who does sort of interim CEO type roles in construction, and before he goes for any job, he sends me the balance sheet, and I can usually do it within a couple of hours. Just look at this, go ask this, and the next stage of what you need to do really. But yeah, 3 to 5 days to do a decent one, and you obviously need the cooperation of the accounting team there to send you the stuff that you want. But yeah, it shouldn't take long, and yeah, and then you're almost then setting up both profit and cash areas to go at, straight from that review, and you can hit the ground running then. So
amazing, short time, non-evasive, and what you get out of that is you either get confidence that everything's been done right, or you get an indicator of where to look, where it's going wrong, and then you can make another decision, which is, do I fix it or do I leave it? And that's a different decision.
Yeah, absolutely right. Yeah, and also it will tell you straight away, because as soon as the CFO goes and asks for the control accounts for last month and finds he or she can't get them, like that tells you
there's an issue.
Exactly.
Well, here's a load of Excel.
Yeah, here's a load of Excel, and then you spent. Yeah, but anyway, but no, that is definitely a way to start any kind of turnaround or whatever. It's to start with those two things, I think.
I'd love for it to become just good practice, not we need to. I'd love it to be we're doing this because we do it once a year. I'd love it to be something like that.
Yeah, absolutely. Yeah, 100%. I mean, in one of the bigger, like a huge food company, it hadn't been done for nearly 18 months, the balance sheet, and
wow,
it was just they were just ticking over and whatever. But we actually got that to quarterly reviews with each of the facilities around the country, and then the CFO would sit in on it, and with his knowledge as well of how the business operated, he was really able to push down and say, that number can't be right because you've sold more this month, or the analysis of that, and it was but yeah, we got it to quarterly, which was excellent, and the controls became stronger, the reporting became easier.
Well, you can't improve what you don't measure, and I think it comes down to some of that. I think we've done the takeaway bit. I think everyone understands what we're trying to do here, what type of information we're trying to get across. I think ultimately a lot of businesses should be doing this, especially now. I think some are looking at cost reduction, and quite dramatic cost reduction at the moment because they've got lower sales. But I don't know how many are doing the balance sheet review first and doing something like this to try and find the profitability before they're, let's say, for instance, laying people off, or or some of the extreme measures that they feel like that they have to do. So I think
Yeah.
this is very timely, and I think a lot of people will get a lot from it.
Oh, thank you. Yeah.
Great stuff. Anthony, thank you very much for your time, sir. This has been
All
great
right.
speaking to you.
Yeah. Thank you, man.
All right. See you soon.
See you later. Bye.